Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. This video is designed to illustrate both the relative importance of time in the market versus fair valuation. I've had comments on recent articles I've published where people talked about time in the market is more important than fair value. Now, ironically, I actually agree with both of those concepts. I think time in the market is one of the most important principles that an investor should follow. It relates to the Ben Graham. In the short run, the market's a voting machine. In the long run, it's a weighing machine. And what that means is, in the long run, the strength of the business is what generates the returns. In the short run, it's the buying and selling habits of individual investors, which is often emotionally charged. So I'm going to, first of all, utilize Starbucks to illustrate, number one, time in the market, because one of the points that I've made before, I'm going to go and pick a time here where I've got the highest PE ratio for Starbucks that I can find. This was March of 2006, and I'm using month-end closes here, so I'm using a month-end where the PE was 56.6. Now, by any measurement of fair value, I would consider that overvalued. Clearly on the fast graph, you can see the fair value was a PE ratio of about 18.5. That's the value of this orange line. So this is, multiples of what that fair value is, and you can see that the stock did very poorly as we came into the Great Recession. But what I really want to do is talk about the importance of time in the market. You really can't overpay for a company that's growing as fast as Starbucks did over this time frame. The average growth rate was 18.5%. So if I price this through yesterday's closing price, you could see that a $10,000 investment would have generated $3,000+ of dividends. It would have turned your $10,000 into $33,000 of growth for an average of 235% total return, or a 10.2% annualized. So time in the market actually overcame being stupid enough to pay a ridiculous valuation for even a great company like Starbucks. So time in the market is a very powerful concept in its own. However, next I'm going to talk about valuation a little bit, and this is coming into the recession, but it just allows me to illustrate a point. So now I'm going to pick a time when Starbucks was trading at the 18.5 PE ratio, which in this example is a PEG ratio of 1. It's the PE ratio equal to the company's growth rate of 18.5, and then holding it till yesterday's closing price. Now I want you to notice there's, almost 3 years have passed, so it's a lot less time. So the question is valuation more important than time in the market? So here we have less time in the market. However, what we have now is an opportunity where we got $8,638 in dividends instead of $3,000 in dividends. And instead of turning $10,000 into $33,000, we turned $10,000 into $96,000, which is a 25.7% annualized rate of return versus just over 10. So time in the market was important. It overcame even a bad decision, but buying at fair value with less time in the market actually generated a significantly greater rate of return. Valuation will generate more returns for you if you are in the market long term, because what it does is it allows you to participate in the growth of the business. And in this case, you can see the orange line was growing, but you also still have a period of overvaluation. But you had a period of overvaluation occurring whether you bought it at the very high valuation back in 06 or whether you bought it at its growth rate, coming into late 2008 during the Great Recession. With my second example, I'm going to take a look at investing in Campbell Soup. Now, Campbell Soup is a lot different than Starbucks. Number one is I want you to notice the growth rate is only 2.4% over this time frame going back to 2001. I also want you to notice the cyclical nature of this particular company. But let's go back to when Campbell Soup was trading at a very high PE ratio of 21 times earnings in December of 2000. That's a very high valuation for a low growth stock. And if you held it through yesterday's close, you would have averaged 2.9% annualized rate of return. But I really want you to notice this. This is over 18 or 19 years or so. You can do the math. I haven't done it. But the point is 10,000 would have grown to $11,568, and you'd receive $5,143 in dividends. And that's where your 2.9% annualized return, or your total rate of return of 67% amortized over all these years, came into effect. Now watch what happens, however, if you buy the stock at a much lower value. And so once again, before I do this, I want to make something clear. I'm going to buy this stock at a normal PE of 14.5 in February of 2003. That compares to buying it in December, or really December 29th of 2000. So it's about 2.5 or 3 years later, but I bought it at a fair valuation and I held the stock through yesterday's close. Now what I want you to notice is your dividend income, first of all, was significantly better. Instead of only earning $5,143, you'd earn $7,858. So the point is you actually owned the stock for a 3-year shorter period of time. And also, instead of turning $10,000 into $11,500, you would have almost tripled your money, turned $10,000 into $27,000. So once again, time in the market is a very powerful tool. There's no question about it. In both examples, it showed that you could actually make money as long as you kept your money invested in the stock over a long period of time. But clearly, time in the market with good valuation is even better. Valuation, in my view, is the most important attribute that investors should be focusing on because it allows you to participate in the company and the growth potential of that company over the long run. If you overpay, you end up with, the opportunity to see PE ratio contraction. You're paying too much and you're also taking too great a risk because at the end of the day, the PE ratio is all about earnings yield, which I'll be talking about in a forthcoming video and as well as article. Now, in closing, and to summarize what I'm trying to illustrate here, I'm not really talking about whether it's SBUX or Campbell Soup, and now I've got FactSet Research Systems on here. What I'm really talking about are the principles of time in the market versus valuation. Both of these are extremely important. If I take a look at FactSet, for example, and I purchased this company on January 31st, 2001 at a PE ratio of 45.1, that's a very high multiple. This is a company that's grown at 17.8%, and I hold that all the way to yesterday's close. I make 13.9%. I received $6,600 in dividends, and I turned $10,000 into $99,000. So once again, thanks to the high growth of this company and the growth of their long-term dividend income, I ended up averaging almost 14% a year. So a quality company bought at any value that's growing very fast can be good if you keep your money in the market over a long period of time. However, had I turned around and bought this stock, for example, in August of 2001 at a PE ratio of only 26 and held it through year end, instead of getting $6,675 in dividends, I get $9,826. Again, slightly less time in the market here, not quite as dramatic as I showed earlier, but now my $10,000 grows to $147,000 almost, $146,700, which is a 17% rate of return versus a 14%. So time in the market and fair value are two of the most important elements that investors can focus on. If you buy the right stock, you can make money no matter what price you pay for it. You buy the right stock at a sound valuation and you really do well. This has been Chuck Carnevale saying thanks for watching. If you're interested in learning more about fast graphs and how the tool works, you can call us at the number on the screen or email us at www.fastgraphs.com. Thanks for watching.